The mood in the oil market is quite positive. Traders are mulling over the prospects of a growing energy demand in China, where travel for Lunar New Year holidays was hit high gear amid an easing of border restrictions. In addition, shortages of Russian oil in the market are on traders' agenda again. According to the US rating agencies, Western sanctions and retaliatory sanctions from Russia are gradually producing results. True, the opposite ones. According to global credit rating agency Moody's, it's becoming increasingly difficult for Europe to secure energy supplies. So far, this has had an impact only on oil and gas prices. However, there are growing signs of a reduction in supply. This may weigh on global economic growth and contribute to its slide into recession. Based on this, the agency predicts that oil prices will average $100 per barrel this year. Meanwhile, the quotes have already come close to $87 per barrel and are likely to continue their bullish run. Brent crude oil futures have risen above the local high posted on January 3. As a result, the asset temporarily settled above $87, the level of early December. If the quote consolidates above the 87 mark on the daily chart, it will most likely extend gains. Otherwise, a technical pullback cannot be ruled out. In the meantime, the Russian currency failed to break through the mark of 68 rubles per dollar and returned to the area of 69. In effect, the dollar-ruble pair has formed a pretty tight range limited by the levels of 68 and 69 rubles per dollar. This comes as no surprise, as the ruble has already got used to drifting in relatively narrow trading channels. Nevertheless, there is another reason for a gradual rise in the Russian currency. According to preliminary estimates, Russia's current account surplus hit a record high in 2022. Despite a huge number of sanctions imposed by the West, the figure came in at almost $230 billion. This is another indication that the Russian economy is resilient to Western efforts to isolate it, which is expected to support the ruble. Now let's move on to gold. Yesterday, the precious metal entered a local correction, falling below $1,900 per troy ounce. Then it began to recover gradually. The main driving force behind the metal's growth remains investor expectations that major central banks will soon slow the pace of coming interest rate hikes. Given that the next Fed meeting will be held in 2 weeks, gold will most likely continue trading upwards, with the periodic local corrections at least until the end of January. In the short term, gold is expected to return to the level of $1,925 per troy ounce. However, if the price fixes below the 1,890 mark on the 4-hour chart, a downward corrective move will resume. And this is all for now. We continue to learn developments on financial markets. Subscribe to our channel and follow news with us. See you soon.